Welcome everybody to the Alternative Investing Club. Today is April 12th, 2024, and we're going to get started with a couple of announcements before we go to Kyle with Web Street. So first of all, I think that people have been made aware in this group that we have a YouTube channel, and videos have been posted up there for about 2 weeks. Let me share my screen just to make sure that you're all aware of it. First of all, we have our Alternative Investing Club Speakers Hall of Fame, and all the people that have spoken for about the last year and a half are listed here. So if you want to go back and see anybody's talk, if you want to go see Andrew Davis, it's listed here, and you can watch the entire thing. You can also go over to YouTube, and we have, let's see, if we go over here to videos, it looks like we have 180 videos that are posted here from previous Fridays, all ready for your viewing. So we're actually a channel right now that's got a lot of videos and very few views because they all were just posted about 2 weeks ago. I'm in the process of adding the descriptions, and that'll be done soon. The next thing that I wanted to show you, I know there was a lot of interest in the announcement that I made last week that the club itself is starting a fund. And the idea with the club fund is that we would bring speakers in, and those speakers would be declared as a club fund speaker. And if the idea is that we'd bring in high quality institutional type speakers that tend to have larger minimum requirements. DLP Capital, for instance, last week had a $200,000 minimum investment. And so the idea behind a club is to do what clubs do best and bring people together. And so we would start a fund that would have a low minimum, and we would allow people to group their investment together and invest in particular speakers. And the way that that would work is I would let the club basically decide whether a speaker would be good enough to be included in the fund. So if we got enough people together to meet the minimum requirements for a particular speaker, that investment would be placed. And if not, you would simply get your money back, or you could put it into the fund with the previous people that were there. So it's entirely driven by the club, and it's meant to be a way to help you guys in the club get into a higher diversity of assets, and also to have it be driven by the club's decisions. So we did a survey, and actually I'm going to send the link to the survey out right here. I'm dropping it in the chat right now. And this survey basically asked a lot of different questions about what you guys would like to see in a fund. And like I said, I want this to be very user-driven, not user-driven, that's my tech side, member-driven, groups of the club, people in the club. So some of the questions that are here, and there were some really good questions that were put into the do you have any additional questions area. But one thing that was interested is we got 42 responses initially, and I'm hoping that since I put the link in the chat just now, we're going to be getting some more responses. But about half the club is accredited, and then a little over 28.6% is not, and 21.4% weren't sure. So I'm really quickly going to go over the definition just so everyone knows. An accredited investor, there's there's a couple of ways you can qualify, but the two most common ones are the net worth test and then the income test. And the net worth test says that if you have a total of $1 million of assets, not including your personal residence, then you're accredited. The income test is if you as a single individual have made more than $200,000 for the previous 2 years, with the expectation that you will have it again in the third year, then you as a single individual are accredited. If you are filing jointly with somebody, then the requirement is $300,000 for the previous 2 years with the reasonable expectation of it in the third year. That's the definition of accredited. There was some recent rules that were brought through the SEC on accrediting people that are financial advisors. Apparently, it turns out that financial advisors who weren't accredited were advising a lot of people who were accredited, and I suppose it got awkward. So now you can take tests if you're financial advisors in order to do that as well. this is a bit self-selecting, but 92% of the people who answered survey said they were interested in creating the fund. And 83% of you said you were interested in DLP Capital. So I will be following up with that. I actually have a meeting directly after this with a potential lawyer for creating the fund. So that is currently in process. In terms of the minimum investment, the vote here is as low as possible, really. I think that's the overall theme that I'm seeing here. Now, I do have to balance that because whenever a fund is filing its taxes, the tax preparation can actually be very expensive. We're finding that for syndications and funds that we've run, it can be $300 to $500 per K1 per year. So the fees that the CPAs get are significant. And the problem with having a lower threshold is that we'd have more people, which would drive the CPA and other fees up. So there's a balance between minimum investment and expense fees. And obviously, we want to keep the expense fees down too. So I'm leaning towards 25K being the number here for a minimum investment. But again, the survey link is in the chat. If you disagree, let me know. Are you interested in the fund including non-real estate investments such as oil and gas, SaaS business companies, things like that? 81% of you said that you were, and that actually took me a little bit by surprise. I guess I shouldn't have been surprised. 18% of you thought that they should be separate. There should be a real estate fund, and there should be a SaaS fund or an other fund. And I personally am leaning towards combining them together on the advice of lawyers and CPAs, figure out which ones actually work well together, because there's different pass-through benefits on oil versus real estate, for instance. So I like the idea of doing that, particularly because some investments are more liquid than others. And so, if we have a bunch of liquid investments, that increases the overall liquidity of the fund. Some have higher cash flows than others. Some have higher IRRs than others. And so mixing the right blend together in order to balance liquidity, cash flow, and appreciation is a tricky thing. And so, and like I said, the decisions are going to be driven basically by you guys hearing the speakers and just deciding if we raise enough money to put in the minimum amount into that group, we'll do that. Now, having said that, one person actually asked, hey, Daniel, do we get to be part of choosing who the speakers are going to be? And I think that's a great idea. I'm going to roll out, we've talked about the idea of sub clubs before, and I'm going to roll out a sub club where that is one of the things that you do. And I think the idea would be that, we'd on a weekly basis find 2 to 4 potential investments and then come together once a week in order to, walk through them and see which ones we like, which ones we don't, which one we want to be the speaker. So more details to come on that, but I definitely want to make this club part of the process at all points. Would you rather it be focused on cash flow, growth, or both? Both was the overwhelming answer here. And I think that's good. The GSC fund that I launched earlier was primarily focused on growth. And I actually found out just by talking to people that in general was not what you're interested in. You're interested in both. So this one we'll try to select speakers that follow that pattern. So here's some of the interesting questions, and sorry we're taking a little bit of your time, Kyle, but I'm almost done. First of all, if you have any questions about whatever I've said, go click on that chat link. The survey is in the chat. I'll put it in there again for those of you who just joined. Feel free to fill that out. I've actually added a question as to whether you would be interested in investing in Web Street. So I know you haven't heard the presentation yet, so don't answer that yet. But here we are. I find the idea interesting and would participate pending details. Do you anticipate that any additional fees would be inserted through the club? How would reporting be handled? And would that be through the parent vehicle or the club? So First of all, there are SEC reporting requirements that any fund has to follow. And so anybody who invested in the fund would get a report. That report would probably be either on a monthly or a quarterly basis. I need to figure that out. And you'd have access, of course, to, all the people, all like DLP or whoever else that were in the fund. And so you could go and see how their individual fund was doing. But there would be a Alternative Investors Club specific report. In addition to that, I would also bring it into this meeting maybe once a month and just go over, hey, during the last month, we placed investments in, these two people. It was a total of 400K. These are the groups that have given us distributions over the last few months. These groups are looking good. These groups are underperforming. I'll just give a quick 5-minute update on about a once a month basis in the club. And then the fees. So the fees, anytime you have a fund, it is a legal entity. It has tax requirements. It has fund administration requirements. It has all of those requirements. And it's no small amount of work in order to find good investments and review them. So there would be a fee. I'm currently going around and interviewing more CPA firms to see if I can get better prices on K1s and K1s that don't take forever in order to be sent out to us, because that's frustrating. A lot of CPAs, if you pay, an extra amount, will bump you to the top of their list. And a lot of large syndications do that. But otherwise, you're sitting in there in the queue with everybody else, and you're just sitting waiting for your CPA to send you your K1. So the fees would go towards, fund administration and expenses, pretty much like any other fund. Let's see. More presentations on real estate investments. Would we take part in vetting the funds? I answered that earlier. I love the idea. More info. If you have any other questions here, I'm concerned about double fund fees for AIC, and the fund that they would buy into. And of course, that's absolutely true. Every administrative level has a fund or has an expense that they use in order to fund the administration of a fund. It's typical in a fund-to-fund structure. So assuming that we insert an SPV, what are the additional costs? Would you share fees equally or proportional to the investment? I'm not exactly sure what that question means, so feel free to put in more detail. But in general, thank you for the interest, and I'm going to be following up. I have a meeting directly after this with the fund's creation. All right. Now I've taken way too much time. Kyle, I'm going to hand it over to you. I'm excited about this particular talk because this is not a real estate talk. You invest in software companies, SaaS and content and other types of software, and you provide your investor return through the profits of these companies that you have specialized in building up. And so feel free to introduce yourself, and we're anxious to hear from you.
Sure. Sounds good. Thanks, Daniel. No worries on the time. You had me smiling pretty much throughout that questionnaire because I won't get into the details of fund management, but as operations manager at Web Street, I deal with all of the K1s and fund admin. And we actually have a ton of investors who come in and they pool money just like you're doing. Some of them use TribeVest or other vehicles, but we can talk offline about that.
TribeVest is a good one. Yeah.
TribeVest is a good one. Yours is what you're looking for, probably you probably need a little more specialized if it's going to be mixing cash flows and growth and stuff like you said. But anyway, we can talk offline about that. I might have.
How's your CPA? I want to know.
That's what I was about to say. He's actually great, and
okay.
We can make an intro. So I'm thankful to say that we got our K1s out on time this year, and it was I'm glad it's in the rearview mirror. Cool. So thank you guys for having me. Friday afternoon. My name's Kyle Kudareski. I'm the operations manager at Web Street. I'm going to just take over screen share. Daniel, I know you said you could do questions throughout or at the end.
Yeah. The way we normally do it is people just put it into the chat, and then I would judiciously interrupt you throughout the talk, or we can save them to the end. Your choice.
Please do interrupt. this is a little different from my normal. Normally, when we're talking fund specifics. This is more of an educational. I'm not going to be talking the details of a currently open offering. So some things may not be super clear. So feel free to interrupt me if it needs to wait till the end. That's fine too. But yeah, no worries on that. Cool. Here we go. Okay, so titled this today, The Power and Potential of Investing in Online Businesses. That's what we do at Web Street. Let's see here. Quick agenda. So we'll do an intro. I'll talk about why investing in online business is powerful, who should consider. This is not an investment for everybody. There's a particular type of investor it makes a lot of sense for. And then we'll get into the different models, like you said, SaaS, content, other softwares, Amazon sites, things like that, and who's running these businesses, what makes them qualified, and then some time at the end for Q&A. Okay, a little bit about me. Like I said, Kyle Kudareski. I live here on St. Simons Island, Georgia, on the East Coast, opposite coast of most of you, I think. I went to school for engineering, got into project management, corporate America. It treated me well for many years, but like many of you, I wanted to invest and maybe create a side hustle or just do things outside of a W-2 employee. That's when I learned about online businesses. I was just looking for any potential side hustle. And I ended up going the real estate route, which is what brought me and Daniel have a mutual friend, Matt, who've done some real estate investing, and I think he spoke at this club years ago. So I still run vacation rentals here on St. Simons Island. Treated me well and mostly passive at this point, but that introduced me. When I was looking, I learned about online businesses, and I didn't end up buying one, but I kept an eye on that space because I was really intrigued by the potential, and eventually I got into the industry. And I say all that just to build a little bit of credibility and why I am somewhat qualified to be speaking here today. Same thing on this slide. So there's a lot going on here, but this is, there's a company called Empire Flippers. Some of you may have heard of it. It's large in the online business space, in the corporate or American, global space. It's not, on the Intel scale, it's not that huge. In the online business space, it's a very large player, Inc. 5000 company. Basically, Empire Flippers is a brokerage. So just like a physical business brokerage, they're an online business brokerage. Daniel builds a website or software. He wants to sell it. He might go to Empire Flippers and they would help find a buyer. So that brings me to Web Street, which is the sister company of Empire Flippers. Why were we created? So Empire Flippers has been around for about a decade, a little longer actually, facilitated over half a billion, so 500 million plus in businesses brokered. So that'll be important later when we talk about who's running these online businesses, because we have a really large network of people that have bought and sold multiple businesses. But as we continue to grow at Empire Flippers, we continue to hear, can I give you money to run these sites for me? Or can I invest in these sites? And we always said, no. It's not what we do. That's not our model. Well, after saying no enough, we decided to make a way for people to fractionally invest in online businesses. And it's this very similar fractional model that you might see. There's Vinovest. You were talking about wine earlier. There's Masterworks for art. There's all kinds of Fund That Flip and Yield Street and all these for real estate, collectibles, sneakers, whatever it is. We're doing the same thing for online businesses. That's the simplest way that I know to explain it. We basically pair investors with professional online business operators and generate good returns for those investors. And we're much younger than Empire Flippers. We're about 3 years old now, a little older than 3 years old. We've raised over $45 million. We've purchased over about 40 assets. And our target rate of return is 20% over the life of those funds. And I'll get into the details of how the funds work and all that. And we're right on track for that. We do quarterly distributions. So you were talking about cash flow plays earlier. We hope these businesses grow and there's a growth potential to them. And if the operators do what they're supposed to, they certainly will. But this is a really nice play for cash flow because you get quarterly distributions throughout the life of the fund until the businesses are exited. So I threw a lot at you there, Daniel. Is there any questions so far? Should I Sorry, I have two screens
Yeah,
going on here.
no questions so far.
Okay. Cool. I'll just keep rolling then. So that was the birth of WebStreet. We were always planned to be a separate company from Empire Flippers, but we had a ton of shared resources at the beginning. We built our own platform, fund admin, all that stuff you talked about, and now it's completely separate. All right. So taking a step back from us, why our online business is intriguing. This is what really brought me. Again, I still heavily believe in real estate, but this is what kept me so interested in online businesses. So we think it's still really, really early in the days of the internet and making money on the internet. A lot of people, to us probably in this room, it's common sense. When you're visiting a site, when you're doing something on your phone, you're probably paying somebody or they're getting your data, or like there's a benefit to whoever's running that. To a lot of people in the world, they still don't realize how much money is being made on the internet. So these are real projections just in the last week or two. 25% of the global GDP by the end of next year is what's projected to be in the digital economy. 10 years ago, that was 15%. So that in the global economy scale, that's a huge number. Same thing in online retail, 6.5 trillion by the end of this year, which would be almost a quarter of all retail sales. A few other big numbers here. The SaaS market, we'll hit on SaaS a good bit, is projected to reach 232 billion by the end of this year. And content marketing, which this is a broad category, right? Involves, of course, social media, but blogs and review sites and all types of things, is projected to be over 400 billion. So big numbers there, but that's kind of the why behind what we're doing. There's just tons of opportunities and tons of new opportunities every month, every year, feels like. So why online businesses? Diversification, I'm going to probably sound like a broken record on this one, and I know you guys know to diversify, but for a lot of us that are heavily invested in the S&P and real estate, maybe a few other alternative investments, this is just another avenue to diversify. Typically, it's non-correlated. These sites can be very independent, and software can be very independent and non-correlated to the S&P 500. So it's a good way to diversify. Would I suggest that you go all in on online businesses and nothing else? Absolutely not. But this is another good channel, and that's the why behind WebStreet. Right now, we're the only ones making it possible for people to fractionally invest in online businesses, other than some private labels and things like that out there. But the growth potential is huge. I just hit on all those numbers. And then again, accessibility. Until now, it took private labels or knowing somebody in the industry to be able to invest in these types of assets. We make it accessible to all accredited investors. Currently, it's worth noting, you mentioned the accredited thing earlier. Currently, we are offering only for accredited. We may do some crowdfunding and smaller things down the road, but that's not our intention for a lot of the reasons you mentioned, Daniel. It just becomes really cumbersome, investor relations, K1s, et cetera, et cetera. But we make it accessible for all accredited investors. We make it super easy. So what are some of the challenges? If you were to want to invest in online businesses, say WebStreet wasn't in the picture, or even with us in the picture, finding the right opportunities. So I'll make probably a good bit of real estate analogies in the next 15 minutes or so, but finding the right opportunity is hard. Daniel hit on that earlier as well. Like it's no small amount of work, I believe is what he said. Same thing for online businesses, and maybe even more so because if you're going to invest in an apartment complex, right? You want to know, is it a good neighborhood? Is it near, big interstates? What's the school districts, et cetera? What's the maintenance of the place? Who was the builder? Who's the operator? Same thing for online businesses, but a lot of that is not very visible or very public knowledge. And so finding the opportunities can be really difficult. And then same thing for real estate, like who's the operator, right? Who's going to manage it? Is it a company? Is it somebody is the operator coming with the purchase of the place? So there's operational management, risk management. Those are both skills and just as important in online investments as anything else. Let's see. So yeah, I've kind of hit on this already. We saw all those challenges as an opportunity, and they're big challenges. We work hard. We're a small, passionate team that wants to basically create an alternative asset class. for people to invest in. So we simplified the process. We connect investors, we connect operators, people that have built and sold multiple websites that want to continue to put their skills to work and grow their portfolio. We pair them with investors, and we think we're in the perfect place to do it, given our history with Empire Flippers, etc. Cool. So I'll pause there. That's a bit on the online industry. I'm going to talk a little bit about our investors. I'd just encourage you guys to think about, how diversified are you? Is this something that might be of interest to you? Generally, we have 4 types of investors, and these are real investors. We've done some case studies recently. So Sarah is somebody that's bought and sold multiple online businesses, right? So she has expertise in the online business industry, but she just doesn't have any interest in running the sites anymore. Maybe she doesn't want to learn the new skills that it takes to implement the new AI tools, or maybe she just knows the upside of online businesses and has had success in this industry, but doesn't care to run the sites anymore. She wants to invest passively. The next, which will probably hit home with a lot of you guys, is tech savvy entrepreneur, somebody that's come through, say, a Silicon Valley or some other corporate America route, but has a lot of tech skills, knows online businesses, doesn't care to learn to run websites or run Amazon sites or build another piece of software, but wants to take part in the upside. So similar things there. Strategic investor Phil. So this is super common for us, people that are heavily in real estate, want to stay in real estate, but want to diversify, basically. And then the hands-off investors, somebody that's just heard. So we have different RIAs, registered investment advisors, family offices, things like that come to us, and they vet the opportunities, and then they have somebody that's completely hands-off, that just wants to invest and trust the investors. So, or trust their family office, whatever the case is. So that's Jules. This was the case study I just mentioned. I actually met with Chuck, and he's been a repeat investor. So 50% of our investors invest multiple times. We do a fund about every quarter throughout the year. And so Chuck has been with us 3 times. He was a big real estate and just traditional investments. And he just really loved the products we offered and the transparency we offered with it, the returns he was getting. And so we have a case study up on our site. I'll throw a link to it at the end if you guys want to read some of why he was interested. Okay.
Hey,
I'll
Cal,
pause
should
there,
I?
Daniel.
Yeah,
Go ahead.
I could. There's been a number of questions.
Cool.
So, and many of them are kind of the normal questions that you would expect to pose to a fund person, like, what is the risk like? And have you lost principal?
Okay. Let's see.
That was
Sorry,
the
I'm
first
scrolling here.
question.
How is the risk? How have you lost principal? Okay, so we've done. How is the risk? Is kind of a broad question.
It's hard to answer.
Yeah.
Yeah.
Online businesses are a riskier type investment. I would say generally, taking my Web Street hat off, just speaking investor to investor, they're a riskier type investment. The landscape changes quickly, right? So with real estate, you don't have to worry about Google algorithm updates or Amazon cutting down on commission fees or Chat GPT rolling out or things like that. I think that's why it's super important to, if you invest with us or if you invest in online businesses in another way, to really trust the operator running the business. Have they been doing it for long enough? What's their track record? Have they been through multiple Google algorithm updates? Have they been through multiple, changes with Amazon? So it's a riskier type investment, but to wrap that up, no, none of our funds have lost principal yet. Our average cash return or average annual return, cash on cash, this is distributed to your account every quarter over the life of all of our funds, is 11.8% right now. And that doesn't include the exit of the businesses. So we generally say that we'll purchase these businesses, we'll let the operator run them, and in the 2 to 4 year range, we'll sell the businesses. So obviously, if the businesses grow, the investors take part in the upside as well. So that number 11.8 doesn't include the sale of the businesses. So no, we haven't lost principal. Yes, some of those operators are underperforming. Some are performing extremely high, but generally we're distributing about 3% per quarter to investors. And we
Okay.
definitely don't encourage throwing a dart at the dartboard and picking a single operator. We do a diversified fund model, and for all the reasons you would expect.
All right. I'm going to jump down a little bit here to
Cool.
Ramesh's question. It says, how do you vet an online business before making it available in Web Street?
Perfect. Yeah, that's a really good question. So what we actually do is we bring the operators to the platform. So when you invest, the operators put in 5% of their own money. So on a $2 million fund, they're investing $100,000. Um, investors invest, say the rest. Then they go out and they have an acquisition period of 90 days where they purchase those businesses. So we not only do we vet the businesses before they're purchased, we vet the operators um, very, very in depth. We've had thousands of operator applicants, and we've had, I think, 13 in the last 3 years total that we bring on board. So obviously, we're putting our name behind the operators that come on. Um, and that kind of goes back to the Empire Flippers days. Because our network is so big of people of the online business industry, we kind of know the people that have bought and sold multiple times, the people that want to continue to grow their portfolios. So that's a really good question. I wish I had more time to go in depth on it, but we're extremely diligent in our vetting process, both of the business and the operators. Reach out to me afterward and we go into more detail on it.
Glenn is asking, what's your tax reporting requirements? K1, 1099, state level, consolidated? Are they all consolidated into a single fund K1?
It's a K1 for each fund you invest in. So when you invest in a fund, there's 2 to 3 to 4 operators in each fund. So we diversify within the fund. Generally, you would have Amazon FBA, maybe 1 or 2 SaaS operators and a content operator or an agency. Like we diversify the monetizations within the fund. You get one K1 for that fund. And we've always gotten them out before March 15th, actually, because we have a lot of people invest through entities. So they have an earlier deadline. So I hope that answers it, Gwen. I'm solely responsible for the K1. So if there's any issues, reach out to me on that one.
Uh-oh. I am going to skip down a little bit more. I'm assuming you might have something in your presentation about this more, but there's a general question on what kinds of what kinds of businesses. Can you give us examples of businesses that you've invested in?
Yeah,
Um,
that's actually coming up right
okay,
next.
then I'll do one more question and we can
Cool.
jump to that. And the question is, what are the typical hold periods and exit plans? And can you get capital automatically reinvested?
Yeah, good questions again. So 2 to 4 years is what we advertise. It would never be less than a year. You don't want short-term capital gains. It could be longer than 4, but generally 2 to 4 years. That's the range we think. Each operator has different strategies, right? So depending on the monetizations, which I'm about to get into, they might be introducing more products, new products. They might be doing marketing. They might have a team of content writers that are going to crank out content and get them to the top page of Google. They might have um, a great team of engineers that can improve a software. So we give them some discretion on when they want to sell, right? Has their strategy been fully implemented? Has times changed and their strategy doesn't work anymore and they want to go ahead and make an exit and get the investors their return. So long-winded answer, 2 to 4 years is what we advertise, and that's generally what we've been doing.
So
It is worth
there's
it
a
is
number of
worth
good
mentioning.
questions.
It is totally illiquid until the exits are done. So that is definitely worth mentioning. That's one of the I don't know if you call it a risk, but it's definitely part of the terms.
Which I think is pretty common to most private
Common,
funds,
yeah.
right?
And I guess the
They're
other thing
owning
I didn't hit
assets, you got
on,
to sell them before you can give your money back.
correct. And you definitely can reinvest. So you'll get your quarterly distributions. We call it our Web Street wallet. It just goes, in your Web Street account. You can withdraw it and have it in your bank account in a day or two, or you can let it sit there, or you can reinvest it.
Okay.
Only last thing I'll say on that is, say we raise a $2 million fund, we're definitely not going to spend exactly $2 million. Um, we've our goal is to spend 80% of each fund. We don't want to buy bad businesses. If we don't spend the money in the 90-day acquisition period, we return the funds to investors with interest. We put them in risk-free T-bills, which is around 5% right now. Unfortunately, we just wrapped up a fund and we returned about 75% of the capital, which is not what we want to do. But we would much rather do that than buy risky businesses or businesses that don't fit the operator strategies. So a lot of things, there with the money, but that's our top priority: investor returns.
Okay. We've got a number of other good questions, but I'm going to let you continue on in your presentation a little bit.
Cool. This is really, I think this is the last most important thing to hit on, and we can just keep addressing questions. So these are the main business models. Amazon FBA, I'm sure you all know, fulfilled by Amazon. Basically an e-commerce business model where products are sold through their platform and logistics are handled by Amazon. All the person does is they source the products generally from China or somewhere else that's a lower cost place, and it goes to an Amazon warehouse. They handle everything else. Now, of course, there's tons of strategies involved here with reviews and advertising, etc. This got super popular in the last 5 to 10 years. It's very competitive right now. We have a lot of this in our portfolio, but we're super picky on who we bring on. They have to have a really big track record, really long track record, and be experts in their field or their niche, right? Niche is very important for FBA. On the opposite end, KDP, Kindle Direct Publishing, they changed the game on publishing, right? You don't have to go to a HarperCollins or one of these big publishing houses anymore. This is much less competitive than FBA. And we don't have a ton of this in our portfolios, but we do have one particular operator who's doing a great job, and he's been a repeat operator with us.
I
Content sites, go ahead.
I was just going to ask for a little more detail there because I don't think I quite understand Kindle Direct Publishing. Are these
Sure.
authors that are publishing themselves, or is this like an online publishing house that helps authors publish?
So basically, what it is authors, but it can be it's a wide range. So it can even be things like handwriting books or coloring books or that type of thing. It doesn't necessarily have to be fiction, nonfiction books, but basically Amazon made it to where I could write a novel, right here on my computer, and I can publish it myself basically without having to go find a publisher and get it approved and all of that.
So if you can publish it yourself, why would they need your business or your funding in order to publish it?
Because generally they have teams, so they're doing lots and lots of different books. Now, where this got a little squirrely is recently with AI, because people are doing all this AI generated content. And so Amazon has definitely cracked down on this. So again, whether it's through WebStreet or whether you're thinking of going and doing your own Kindle publishing, it would only trust people that are really, really experts in this field because it's changing very quickly. But also, I guess the other part of that is it's generally very beneficial to do both. So you wouldn't just publish through Kindle. You would also sell a physical copy of your book, and their publishing house makes it possible to publish physical copies as well, which takes more funding, but has better margins.
Okay.
Content sites, you guys all know these. So top10travelbackpacks.com, Wirecutter, could be, any of these blogs or review sites or affiliate marketing sites that also combine display ads in. This one's been around for the long haul. You saw the numbers on how big this has continued to get. There's social media aspects, etc. I think people probably consider this riskier with, again, AI tools, and we all hate the websites where you can't get to the content because there's so many ads or there's just, BS affiliate links. That's not what we're talking about here. We're talking about high quality content sites, high quality review sites. Again, teams with expert writers, expert teams that know how to get ranked on Google, that just crank out affiliate commissions. So a lot of different types of content sites or operators, and then software as a service. Yeah, this is a wide range too, Daniel. I don't know that how much explaining do you think SaaS needs? I mean, Zoom is a giant SaaS, right? CRMs, marketing tools, any app on your phone, any type of recurring software that you sign up for and either use or forget about, but continue to pay for, that's an example of a SaaS. And what's really, really, and we're very bullish on SaaS. The reason being, well, there's a lot of reasons, but one of them is the recurring revenue model. It's super easy to project what your cash flows are going to be, what your revenue is going to be. And it's much more predictable than a one-time purchase of a product on an Amazon FBA side or something like that. Cool. Yeah, I'll pause there. I know there's a bunch more questions. Did you have any follow-ups on those 4 models?
None on the models specifically. I think most people probably know what these all are.
Yeah.
Um, I'm not sure if this person wants me to use their name or not. They direct messaged the question to me. So I'll just
Okay.
say, who does the day-to-day operation of the businesses? And are you primarily investing equity or are you investing debt?
No debt.
No
No
debt.
debt.
Okay, it's all
No
equity.
debt. All
Or,
equity, which actually makes us we think it's a huge it's not that we would never entertain debt, but to date we have not. We
okay.
think it makes us super competitive when we're making the acquisitions, right? We can come in with the cash ready to go, negotiate down a good deal on the businesses, which is obviously better for investors. The day to day is the operators. So I honestly didn't intend on getting this into the details because I wanted to keep it higher level, but I'm happy to do so. So again, we go find the operators, which we think are the top performing operators in the world, right? Some of the best FBA, these people have sold $5-10 million businesses on Empire Flippers or other brokerages. We go find those people, recruit them to, or they come find us. They want to raise money. They want to go buy bigger and bigger businesses. Um, and then we have investors. So it's a two-sided marketplace. The operators and their teams run the businesses. Sometimes they have their own warehouses. Sometimes they have teams of people all over the world doing different things, whether it's logistics or writing content or whatever the case is, doing their marketing for them. So they're doing the day-to-day. We don't do any of that. What we do is we find them, we pair them with investors, we do all the fund that we call it like a fund in a box, basically, right? So fund admin, legal, investor relations. Now, if an operator is struggling, we will help them out. We'll find them somebody in our network, an agency, or we do operator masterminds. We facilitate a whole community of operators, so we definitely help in that aspect. If an operator is doing really poorly, we have the right to remove them. And we have done that once out of all of our funds. We removed one operator, brought in another team. It was an agency as well, or it was an agency, not as well. And they actually, I just got a report yesterday on it. They've turned that business around. So that's who runs them. Again, a bit of a long-winded answer there. I wish I had more time to go into some of these details, but hopefully that helps.
I'm going to insert my own question here.
Sure.
A lot of venture or private equity funds that are buying businesses that I know of often either provide or sell to the operators, some sort of program which is supposed to help them, grow their business rapidly. To
Right.
5x their business or whatever. Here are the 31 points that you need to go through, and we'll give you the training in order to do that. Do you guys go through specific programs or have a specific strategies for buying these companies and 5xing them or 10xing them, and how does that play out? Or do you
Yeah.
just look for the best operators and work with them?
More of the second. It's an excellent question. You're right. There is a bunch of that. We don't do any of that. We are extremely diligent on finding the best operators. But what has happened organically is these operators, they're going through acquisitions together, right? We don't ever pair operators that have the same strategy that would be competing for the same businesses, but they're all going through it at the same time. And so it's kind of organically happened to where they're having masterminds. They're on buyer seller calls each week. They
That's
might find
cool.
a business that doesn't fit their strategy, but hey, it might fit somebody else's in the fund. So that's all happened organically. And we're definitely leaning into it, but it wasn't part of our original plan.
That's cool. Okay.
Yeah.
I'll hit some of the questions here now.
Cool.
And I think you answered this, but maybe it could be a little more clear. Is this an evergreen fund or is it a closed-end fund where eventually you're going to sell all the assets and return the money?
Yeah, closed. We are entertaining some different models of evergreen, but we haven't done any of that yet. So closed. Generally, the way to think about it is we just wrapped up our seventh fund. We literally like a week ago or so. That was a 2 to 3 month raise. So basically Q1 of 2024.
Hmm.
They're now in their acquisition period. They've got 90 days. Now they were prepping acquisitions throughout the fundraise, right? So, but they have the next quarter to make their acquisitions. So just for round numbers, let's call it Q2. At the end of that 90 days, we actually already have some offers out this week. So this acquisition period is going well, but any money that's not spent will be returned to investors at the end of the 90 days. The following quarter, call it Q3, the businesses are all migrated. They're implementing their growth strategies. That's when they're starting to cash flow and you're starting to get your dividends. So at the end of Q3, you would get your first cash dividend. In the 2 to 4 year period, once they're ready to sell their businesses, that's when the fund would officially close. And obviously, they're not all going to sell at the same time. But yeah, one might sell shortly after a year, and one might be toward the 3 or 4 year mark. But that's when the LLC or the fund would close up, and you get the same profit. I should have mentioned this a long time ago, but it's 2/3 of the profits of every quarter and on the exits. So all the profits. It's monitored by a third party bookkeeping company. Um, and
Yeah.
that's the investor cut.
Well, I can see how your business model would lend itself really well to a closed-end fund where people aren't, buying and selling while you're trying to do the operations. Because if you have an evergreen fund, of course, you have to maintain a certain amount of liquidity or undeployed capital, basically, so that people can buy and sell out of the fund.
That's exactly right.
Right. So I'm curious. I would be curious to see how you would do this. I think it's possible, but it'd be an interesting way to strategize on how to do it as an evergreen fund. But I
Yeah,
think
and
it lends itself really well to closed end.
it does. So far, we think it does too. But yeah, we're always open to new ideas. I mean, if we thought we got this perfectly right from the get-go, we'd be lying to ourselves, right? So we want to try things and do what's best for investors. But so far, it's been successful. And for the operators, I mean, if anybody has any operators, people that are interested or in this field that want to come on board, we're always welcoming
Oh, you might get
new
some people in this
operators.
group that know operators.
I figured so, and it's really exciting for a lot of them for different reasons because um we have some that have run their own funds in the past, but they don't want to do any of the fund admin or any of all that stuff. They just want to run the businesses. So that's why they would come to us. Or maybe they've sold businesses, they've built businesses up to a $500,000 sale or $1 million sale, but they want to go buy a much bigger one. And so we help them, do that.
It's a little bit of insider lingo to call them operators, but these are just basically the people that are running the business, right? They know their
Correct.
product, they know their software, they're running their business.
Correct.
And
And we've tried to transition to, if you check out our site, you might see it mentioned as portfolio managers because really they have teams of people, and I can't get out of the habit of saying operators, but we're trying to start calling them portfolio managers.
all right. Can you tell us a little bit? I'm going to combine two questions here, Mario and Glenn's.
Sure.
Can you give us a little bit about a history of funds that have gone full cycle and talk about like average returns and ranges?
Yeah. So across all of our funds, as I mentioned earlier, across all of our funds today is 11.8 percent annual cash returns. That's cash in your bank account if you withdraw it from your Web Street account. We're 3 years old now. Our first businesses are for sale. Some of our first businesses. So we don't have any that have gone full cycle yet. Those businesses have given 2 to 3% returns per quarter, pretty much like clockwork. There was one of the first ones, like I said, that's one where we replaced the operator. It was in the 1 to 1.5% range, dropped down to 0.5% on one quarter. We've replaced the operator and it's turned around. So generally 2 to 3% per quarter, which is about 12% per year. And that doesn't include any exits because we haven't made any yet, but we just listed some first businesses for sale. Two or three of them, I think, at least two. Those we have 17 funds, and within those funds, there's 3 or 4 different operators in each of them. So that's why I'm speaking a bit more in generalities on our site. And if you just reach out to me directly, I can send you a table of every single fund and what the returns have been per quarter throughout the life of them. So I know when I'm listening to presentations or podcasts or whatever, and people are just speaking in generalities, it's a little frustrating. I don't want to do that. I have all the specifics. I'm happy to share them.
We
I
got a
didn't want
couple.
to, yeah, go ahead.
We got a couple of good questions that are looking for more specifics here, but what are the sizes of the businesses that you tend to buy?
The smallest we bought is around 200,000 and the largest is 1.3 mil. Generally, our sweet spot is in the 700,000 or so range. It got super competitive during COVID with all the aggregators coming in and rolling up FBA businesses and all that type of stuff. And they were just, this is a bit of insider knowledge because we still had knowledge of Empire Flippers, what things were selling for. They weren't even looking at the niches or what they were. They were paying above asking price at the time for FBA businesses. So we were not going to compete with that. So we kind of found our sweet spot in that 700,000 range. But yeah, we're definitely not going to buy anything under $100,000, and we're not at the $10 billion mark or anything at this point.
Okay. I'm going to jump down to Glenn's question and then come back to Jellen's. But who are the buyers of your businesses? Do you typically sell to other people who are then operators, or do you sell to other funds like yourself? Who buys these businesses?
Generally, other operators. Yeah. So
Mhm.
I saw Brooke also asked, are we still affiliated with Empire Flippers? So the same founders. Um, we founded Web Street, but we're a completely separate company. The reason I say that is when we first started, we only bought and sold businesses through Empire Flippers because we knew they were high quality businesses. Now we're broker agnostic. So we go to a bunch of the others, Quiet Light, FE International, et cetera, both to buy and list. So yes.
Do, do you work on Flippa out of curiosity?
We shop on Flippa some.
Okay.
They have a completely different model than Empire Flippers, and I'm not saying that in a negative way. It's a bit more of the wild, wild west. Anybody can list anything on there without much vetting, whereas Empire Flippers was extremely. They were, 95% of the businesses that got listed on the or got submitted were not listed.
Yeah.
So it's just two different models. We do private deal flow now as well. A lot of these operators know people that are selling businesses privately, which is nice.
All right. And let's see. Oh, what is the payout model for the operators?
Sure. Yeah, good question. So they put in 5% of their own money, so they get the 2/3 split on that as well. They get no salary or anything like that. They get 20% of the profits. So Web Street and the operators get 1/3. They get 20%. We get 10%. The investors get the other 2/3. All of profits. So if investors don't make money, operators in Web Street don't make money either. But they get
Okay.
20% on the 5% they put in. That's their carry.
Now, and I assume when you say they get no salary, that just means at the fund level, you're not giving them a salary, but they're drawing a salary from their own business, right? Or are they not?
Uh, they don't. No, they don't.
Okay.
Yeah. Sorry, I want to make sure I answer it clearly or correctly. Um, yeah, they don't get any salary. They just get 20% of the profits.
Oh, okay. Okay.
Yeah.
Let's
We
see.
tried really hard to align incentives. Because a lot of these people have had large exits before, and we don't want them to get a year or two into running the business and get tired of it or whatever. So they have to provide returns in order for themselves to make money.
Ashish is asking, when you purchase a business, what is your range for revenue and profit multiples? What sort of multiples I assume, do you buy at, is what he's asking, and what are you trying to
Yeah,
send them to?
good question. It varies by monetization, obviously. FBA and content sites sell it different. But generally, they're much lower than you would see in traditional physical businesses. 3 to 4x annual.
Okay. Okay.
Yeah.
Yeah, I think that's pretty typical. I
Yeah.
think.
When it got really competitive with aggregators that was going from much higher, like I was talking about earlier, it's come back down to earth some, which is nice. It's better for investors.
Okay.
Sometimes
Uh,
lower, sometimes 2.5, but
and I'll finish off with this question Ramesh is asking. Alex, the lockup period, that goes to the closed-end fund, right? I guess you can comment on that, and then I'll ask the last question. Is there a lockup period?
yeah, just the till the businesses are sold. Totally illiquid till the businesses are sold. 2 to 4 years is the range we give. It's not guaranteed.
And then Ramesh is asking, is there any depreciation or what sort of tax benefits flow through to the investors?
Yeah, good question. 15-year straight line depreciation.
Mhm.
Yeah, 15-year straight line. It doesn't have
Is
quite
that is
the
that is that based on asset price depreciation? So the business owns assets, and
yeah. So on FBA, yeah, certainly they own inventory is
okay.
appreciated off of that.
Do you,
On
do
the
you
others,
tend
it's
to buy businesses that have a higher percentage locked up in assets because of that, or how does that play into your strategy?
yeah. So we generally don't think too. It's not a critical factor in acquisitions, the tax strategy. Now, inventory certainly is because a lot of these operators will go in and look at the inventory strategy of the person selling the business, and they'll see opportunity, right? Whether it's around
Mhm.
seasonality, whether they're holding too much, or they ran out of stock too often. So they'll take that into account for the strategy of the business, but not usually from a tax perspective.
Yeah, yeah. Inventory is important. I
I
was
saw one here on minimums too. I can hit on that briefly. It varies from fund to fund. Generally, it's around 60,000 per fund. If you guys wanted to do lower, you know, if you had what you were talking about earlier, if you wanted to do your own fund and then come in, you could come in for 60 generally.
Okay. And I'll drop the survey form again into the chat. If you are interested in investing in the club fund and having the club fund invest in Web Street, just mark it down in the survey there. Otherwise, if you're not and you just want to give general feedback on a club fund, please take the survey. And can we have everybody take themselves off mute and thank our guest Kyle for coming in and speaking to us.
Thanks, Kyle.
Thanks a lot, Kyle.
Thanks, Kyle.
Thank you, Kyle.
Thank you,
Kyle.
guys. Appreciate it,
Thank you,
Daniel.
Kyle.
Yeah, that was really interesting.
Thank you.
Definitely different than our normal speaking.
Thanks,
Yeah,
Kyle.
and I feel like I just scratched the surface. So feel free to reach out, Kyle at webstreet.co.
All right. Sounds good. Everybody have a wonderful day, and we'll see you here next week. Next week we have coming up, let me look at the calendar, Paul Larson, maximizing tax strategies with alternative investing. So
Hey, that
see you
sounds
all
perfect.
next week.
See you guys.